Special guest joins us right now to give us more insight into what's going on. Sandeep is CEO and Head Equity Strategy at Tower Capital and Securities. Sandeep, good morning. Welcome to the show as always here on Profit. Prashant this side. Let me start with a very simple question. Which way do you think the market's going to head? It's an easy question, but a very difficult sort of answer to that. What's your sense about things? We've run up about 50% from March 9th. People are calling it very sharp recovery, or perhaps run up, whatever you want to call it. Stocks have moved up.
Well, good morning, Prashant. Good morning, Namrata. I think I'll have to charge you $1 billion for what I'm going to say for now. But anyways, as you rightly said, Nifty is up almost 45% from the closing lows in March. S&P 500 is up. The US markets are up about 35% or so. And where do we go from here? What we have been advising our clients for the last 3 trading sessions is that to book profits, to be on the other side of the market, because the rally we think is a bit overdone. There's a complete disconnect from the fundamentals. But having said that, rally's got to do more with the liquidity flows than anything else. You've seen the monetary easing by the ECB, by the various governments across the board, the UK government, the US Fed. And what we believe is that money is like water, and it's finding its way into different asset classes now. And if you remember, time and again, whenever I've come on your show, we talked about the biggest threat now will be, in the future, will be the inflation. So I think 6 months to a year down the line, we'll see big inflationary pressures coming in. But first, you'll see that asset class like equities being pumped up. So our view is that sell into this rally.
Sandeep, if you do believe that you are likely, perhaps you are in for some sort of some bit of turnaround from current levels, the obvious question which comes to mind is how sharp or how severe do you think the sell-off is likely to be, or is it going to be just a wave of profit taking which brings the basic indices down to more comfortable sort of levels? What's your sense?
See, we think that, as I mentioned about the liquidity, there's another reason to it. What we think that the market is going to come off in a gradual manner, because the money that is flowing into global equities is phenomenal. And sharp sell-offs will totally depend on how this liquidity moves away from the markets. Need to bear in mind, there's a very macro fundamental shift in global policy that we just can't ignore. If you remember, in November last year, on your show I talked about the Indian money in the Swiss bank accounts. Now if you look at middle of March, since when the global equities have started rallying, it has coincided with the decision that the Obama administration has made that they will not tolerate the tax havens across the globe. They are for the they want full disclosure of all these tax havens. EU has followed suit and has said that if the 20-odd tax havens, if they don't comply with the disclosure norms, they will be blacklisted. And then now, coming back to India, you look at BJP. They're one of the most prominent election agenda that the BJP has. It will bring back the Swiss bank, the Swiss money, or anywhere else for that matter. And 2 days ago, Congress Party has formed a committee that talks about bringing home the overseas money. Now, having said all this, what has happened and what we have learned by talking to people in the market is that the flow of offshore money is going into global equities. That's why we've seen such a sharp rally, such a phenomenal rally, which has confounded almost everyone. And again, I'd like to reiterate that it's just not my view, what we have heard and listened from other people, and that is the same case with the Indian markets. Indian offshore money is coming back into India under the guise of FIIs, and it is something that you may look up. In the last 2 months, if you were to notice that the names of the FIIs that have been investing in the markets, you'll find that these names have never ever invested in India before. Now, for the last few trading sessions, the traditional long-only FIIs have been selling, but the market is going up. So to answer your question, it is extremely difficult to say how the markets will react. It may be a sharp, if the liquidity stops all of a sudden, then you may see a very, very sharp declines or gradual declines. And if the liquidity flow continues, depending on the election results, depending on who comes into power and how focused they are on bringing the offshore money back to India, if they are very focused, then you'll see the rally gaining strength and momentum from here.
Sandeep, morning. This is an interesting point. The names of FIs which have invested have been traditionally non-investors in Indian equities. Can you talk a little bit about that, the motivation for them to invest in a market like India? Could it be because their risk appetite has gone up, so they moved away from a traditional investment market like US? Or is there a deeper reason, a more sort of trading, speculative reason to come into India?
It's a very difficult question to answer. One thing that we are aware of is, I mean, if you look at all the markets, it's just not Indian markets that has been happening. And India has been very sharp because our markets are not liquid enough, are not deep enough to absorb, say, $1 or $2 billion of net inflows in a short space of time. And that's what we have seen. The markets have rallied so dramatically. So the reason has been more to do with, of course, India's fundamental macro situation. I mean, I remember when I was in school, people used to talk about how negative things were in India because 70% of the population was involved in agriculture. But come to think of it, the situation is still the same, and that's a blessing in disguise because we are insulated to a very large extent, if you were to consider the lower middle income group, that they are insulated from the global slowdown. Of course, we have been impacted where there's a linkage to the overseas markets. Industries like IT, auto components, or wherever, the export-oriented industries. But the inherent strength in our economy remains. So I think that is one of the major reasons that attracts FIs into our country.
The other point I want to get more details is on this reinflation that you talk about. You said equity is the immediate asset class where money is going to pour itself, and then later on we prepare ourselves for the inflationary cycle, which is of course much expected. You know, there are two things here, Sandeep. One, on a stock-specific basis or a sector-specific basis, there are cyclicals which are traditionally inflationary, cyclicals, commodities, for example, oil and gas, metals, etc. The other broader and macro point I want to make is India vis-a-vis other countries like Brazil or Russia, which are much better in terms of commodities than we are. We are net importers of commodities. So in that sense, I would assume macro-wise or India rating at the country level gets a little lower versus EMs, but maybe there are cyclicals within sectors you can play.
So are you trying to say that the markets like Brazil and Russia will outperform India?
I'm asking you whether you believe that will happen.
Okay, I'll just give you an example about how oil has behaved lately. If you look at the US inventory data, it has been at about 19 or 20-year high, and the oil has rallied from $44 to almost $54 a barrel. You've seen copper rally very smartly from its lows. Now, in times of recession, the leading indicator has always been copper. So people take a cue from that and have a lot of confidence that so long copper rallies, we should buy into cyclicals and the metal space, or commodities for that matter. I think because of the inflationary pressures, people will always keep wondering because prices will keep going up to a certain extent, but people will also question the fundamental side to it because, as you mentioned, Russia and Brazil are more commodities driven, but they supply to the whole world. Now the question is whether the demand side of this scenario will increase, and our view is that the US recession will continue for at least next 3 to 4 years. Stimulus packages will come and go, but they will have short-term impacts, not long-term impacts. China may show signs of uptick in terms of consumption levels of these commodities. But if I were to draw an analogy of what happened in 1929 with the markets, is in the November of 1929, the US markets crashed and then rallied about 47-48%